I'm so glad to be joining you today for the 2025 playbook here at the Money Show. Of course, you are aware that, being accredited investors, you should know that the Magnificent Seven was the best game in town. Without the returns, the spectacular returns of just seven big technology companies, the S&P 500 performed at half the speed, and the Dow Jones Industrial Average even less than that in both 2023 and 2024. So if you had a conservative portfolio that did not have large cap growth, you weren't doing those kind of spectacular gains. Now, the question is, going forward, will they continue to soar? And what should you do about it if you weren't invested? Should you buy high? What should you do about it if you were invested and you have a lot of emphasis, maybe even overweighted there? Also, what about artificial intelligence, breakthrough technology, cryptocurrency, which you can now get tax protected? Important tool, right? Very important tool there, as well as maybe even exciting developments in quantum computing. Well, let's get started on all of this and more. I'm going to take you into my PowerPoint presentation and we'll get started. So, the Magnificent Seven we just talked about, but what you might not be realizing, or you may, Bitcoin stocks and gold are at an all-time high, but so is debt. Quantum computing is on everyone's mind. When we think about safe havens, silver is still 38% lower than its high in 2011, whereas gold keeps hitting all-time highs. Are there any opportunities there? It's important to realize that bonds lost more than stocks in 2022. Those are long-term government bonds. That was largely the impetus of those five bank failures in early 2023. GDP is expected to slow down a little bit in 2025. Tariffs could stoke inflation, and that would prompt the Feds. In fact, we are expecting a pause this month, and maybe not, not as many cuts as we were anticipating. So, what is your best strategy for 2025? So, again, if you're looking at this one-year return chart, you're seeing that Bitcoin was the game to be in. And again, long-term government bonds lost again in last year in 2024. Here's the 2023 return. And again, bonds are not doing that great. So those paper losses are something you definitely want to be more attuned to as well, especially if you're over the age of 40. So the Bitcoin ETF helped Bitcoin soar to new heights. We now have an Ethereum ETF, and that's down 20% since it launched. Ethereum is actually down 32% from its all-time high. So what about crypto winters? Or should you go ahead and buy high? Now, one of the things that I want to say is that, a few years ago, you needed a crypto wallet or an exchange like Coinbase in order to own crypto. Now you do have funds where you can actually own either the Bitcoin trust or an Ethereum trust in your retirement account. And that's really key, right? Because if you have an asset that does score as big as Bitcoin did in 2023 and 2024, the capital gains protection is very important part of that tool. So that's something to think about. If you haven't owned crypto and you are interested, and we're going to talk about, ways that you want to do that. But in general, you always want to keep age appropriate, properly diversified. Like I wouldn't have Bitcoin or crypto be my entire strategy, but it can be a hot slice of an age appropriate, properly diversified plan. And if you did have it and you just really went crazy over the last 2 years, you are probably overweighted in it. We'll talk about that as well. So what about crypto winters? And this is important because Bitcoin it dropped so far. It hit 69,000 in 2021, and then by a year later, it was down to 15,000. The Bitcoin halving at that time was May of 2020. And the interesting thing is that we are seeing this trend that whenever Bitcoin halves, and we did have a halving event last year, that within 1 year, it really is going crazy. And then the following year, it has the crypto winter that's really somewhat terrible. So April 2024 was the halving event. Maybe April 2025 might be when it's at its high. And then if it follows this historical trend by April 2026, those gains get wiped out. It's the whales. That's one thing that people need to understand about Bitcoin and cryptocurrency. It's the whales. So it's the institutional investors and the hedge funds that are really driving the volatility here. And there really aren't HODL investors because the average hold time for Bitcoin is 100 days. So that's just a little over 3 months. The average hold time for Ethereum is 45 days, under 2 months. So this is still a trading platform. It's not really being used yet as a currency. So again, this is the other halving event, and it followed true to form as well. So we had a halving July 2016. By December of 2017, it hit an all-time high. And then by December of 2018, those gains had all been given up, and we had another crypto winter. So this, particular coin ledger IO, they were saying, hey, this time Bitcoin's going to soar to 361,000. Of course, right now it's more like 109,000. Still very, very high. But again, if you are going to think about holding on and playing that 1 year, maybe you want to, that's okay. If you start seeing it head the other direction, maybe you want to do your rebalancing now. But the spring rally in general can be very reliable. So maybe do that rebalancing, that make sure that you're age appropriate, properly diversified. If you have 6 slices of crypto in your nest egg, and we'll talk what those slices mean as we go on in this presentation. Maybe you trim it back to one. So you capture gains, your nest egg gets bigger. And then if it does enter the crypto winter, you're in the position to buy low instead of, really like losing so much of your net worth and then hoping and praying to recover some losses. So that was Bitcoin yesterday when I put together this PowerPoint presentation. And I think there's another thing too, is that we have to be aware of the fact that there's a lot of fraud in this space. And $4 billion was lost to fraud in 2023, and it involves even celebrities. So, we had Tom Brady, Stephen Curry, even Major League Baseball, all involved in that bankruptcy that was attributed to SBF. Kim Kardashian pumped a scheme called Ethereum Max, which sounds like Ethereum, but wasn't. It was a pump and dump scheme. She was fined by the SEC and paid it off real fast. So again, if you, this is not an HODL platform. If you already own it, you probably should be thinking about when you want to capture gains, whether it's right now or the end of April. If you don't own it, then we should think about dollar cost averaging into it in an ETF within your retirement plan, if that's what you want to do. So again, this is largely a trading platform, not being used as currency yet. I do have 2 crypto blogs that can help you learn more about ETFs, coins, wallets, etc. Email us at info@nataliepace.com if you'd like to learn more. So in general, this is your crypto strategy. Please feel free to take a picture of that if you'd like. So we already talked about considering having a hot slice, not your entire plan. ETFs in your IRAs for tax advantages. Capture gains on it. Dollar cost average if you don't already have it. And think about rebalancing now or the end of April at the end of the spring rally. So again, we talked about the Magnificent Seven. We've now talked about Bitcoin. I do want to talk a little bit about silver and also the Magnificent Seven. So with the Magnificent Seven, there's a couple of things that you want to think about. Most large cap growth funds that I have looked at that are not Dow Jones Industrial based or core funds. So we really want large cap growth where there's year-over-year sales growth, not long-term income growth, year-over-year revenue growth. And you're going to see that these have 40 or 50% information technology. And if it's large cap, it'll be these trillion-dollar funds. So that's an important aspect. That's part of our diversified plan. But we could also have a fund like the iShares Breakthrough Technology Fund. The symbol is TECB. And that gives us even a little bit more exposure to it. And our hots, we want to lean into something that is hot, right? And again, I'm going to show you what a diversified pie chart does look like. But the other side of it, and here you go, year over year sales growth. So all these companies are doing that. Most of them have extraordinary net profit margins. And the one downside is that they're very expensive. So again, if you had a large cap growth fund and that one has now become oversized and overweighted in your portfolio, if you sell and trim it back to the size it should be, age appropriate, properly diversified, capturing gains, making your nest egg bigger. If it keeps going up, great. You still have the ability to do that. If it goes down, you've protected your wealth. So remember that rebalancing is a very, very important part of our nest egg strategy. And this is part of the reason why. You can see that what soars can also sink. So even though the Magnificent Seven is the best game in town last year and the year before, it was one of the worst in 2022. We see that the NASDAQ dropped a lot more than the S&P, and companies like Tesla, which are in the Magnificent Seven, dropped 66%, the Innovation Fund 65%. So again, rather than just thinking the party's going to go on forever, rebalancing helps us to remain sober. And I will be showing you our pie chart, but remember, regular rebalancing is only once a year or maybe 3 times a year at most, not more, not less. So I already told you a little bit about the Magnificent Seven in terms of the performance. And I just want to recap. Have large cap growth where it's year over year revenue growth, not that long-term growth or a core fund. Consider also having another hot slice of Magnificent Seven in an ETF like Tech B. Make sure that you are capturing gains. If you don't already have it, this is another one where you want a dollar cost average in rather than just buying high. Rebalance now if you haven't in over a year. And this is going to be important to know what you own. Was your performance 24% this year? Was it 23% last year? If not, then you probably were missing large cap growth. And you need to start adding that in. Again, we're going to talk about dollar cost averaging. You might have also had the long-term bonds because we see that those were really negative for our net worth. What about artificial intelligence as the hottest industry in the world? I mean, everybody's been talking about NVIDIA. So if we go back to our Magnificent Seven pie chart, you can see that NVIDIA has grown to 3.45 trillion. And look at the gains on the 5-year high and low. It's just gone through the roof, but it also has the sales growth to support it. However, look, this is a company, maybe it's going to earn 60 billion in net income next year, but it's worth 3.45 trillion. And that's what we mean about valuation, is that you're seeing that the amount that investors have invested in these companies is so much higher than its sales. Here's the price to sales ratio, or its earnings. Here's the price to earnings ratio. So that's just what we're saying, is that it's very expensive. It's priced in. So if you would like to own artificial intelligence, then this is one that you want to consider dollar cost averaging into. If you own NVIDIA, rather than buying high, hoping to sell higher, maybe it's time to capture gains. Maybe it's time to even think about an artificial intelligence hot slice, something like ARTY, and this is an iShares one. We have AI and Magnificent Seven stock report cards, so you can email info@nataliepace.com. and we're happy to send that to you. What about quantum computing? So there's an issue with quantum computing. And when, I just did a retreat and I said, what's hot? What are you guys interested in? A lot of people said quantum computing, probably because of the breakthroughs that have been making headlines with Google's Willow. And also there was a room temperature breakthrough. But if you start really dropping down the rabbit hole on this industry, it is very even though it's been around, I mean, I believe Google's had their own quantum computing unit since 2012. And of course, there's probably been R&D dating back even 50 years. It's still not yet a viable monetization platform yet, right? And so you're going to hear a lot about tier zero opportunities that you can get in now. Be careful because this is an expensive R&D project because even though there has been a tiny breakthrough at room temperature, in order for quantum computing to work, they need is freezing temperatures essentially, and that's expensive. That's an expensive energy expenditure. Also, it is prone to errors. Now, that was the breakthrough that happened with the Willow, was that they had achieved some significant process on where the errors were far reduced. So this is exciting breakthrough, but it doesn't mean that they are yet at the point, and they certainly did solve a problem that would have taken longer than the years of the universe for a regular computer to solve. But it wasn't one that there were some glitches in that, right? I mean, there's some, it's not like, okay, now it's ready to, cure cancer and make batteries that are far more efficient and all of the potential that quantum computing really has. So I would be very careful about tier zero opportunities. You have to do about 100 times the research. The fund company that you could have that's a quantum computing fund, this could be a very early stage. The ones that we were looking at were only a few years old. We don't know how well capitalized they are because they're privately held with no credit ratings yet. So I would be super, super careful in this space. If you are interested, Vegas money, but do your due diligence first. Don't just read a stock newsletter. So I would keep my eye on it. I am going to be posting a quantum computing blog very soon. Obviously, this is something that we're going to be covering in our retreats. And by the way, we look at what's hot one full day at our retreat. So people get to really drop down the rabbit hole themselves on some of these as well. Our next one is going to be April 25th through the 27th. It's online. And if you register by January 31st, you get the best price and a free private coaching session with me personally. So check that out. Go to nataliepace.com. There's a flyer there. You can email us for more information, info@nataliepace.com. But the bottom line, again, you can take another screenshot of this if you want, is that you just want to be very, very cautious. It's not your nest egg. It's not money while you sleep. And even though a lot of the Magnificent Seven companies started out at tier zero opportunities, they really, really took off not at the point where the R&D was in development, but at the point where they had a product. So Apple took off when they launched the smartphone and everybody wanted one, and they had the ability to give everybody that phone. And they even figured out how we could spend so much more on it than we had spent on our flip phones previously or our BlackBerry. So this is that sample pie chart that I've been telling you about. And you always want to be age appropriate. So if this 30-year-old is keeping an age safe, that's 30%, we are in our sample pie charts overweighting an additional 20% safe. That has to do with the amount of debt in the world, the fact that stocks are very expensive, the fact that the economy is slowing down, the fact that tariffs could actually stoke inflation. So if you want to de-risk your portfolio, just overweight a little bit safe, right? That doesn't mean jump all in or jump all out. Now, for most of us, if we actually did a pie chart of what we have compared to what we should have, we're going to be overweighted because we had two spectacular years in stocks, 23%, 24% on average in both 2023 and 2024. So we are in a position, especially with our large caps, where this is probably too much. We're overweighted there. So again, we draw a picture. We put in an Excel file or a Pages file of our holdings. You can ask us for a free web app where you can personalize your own sample pie chart, and then it becomes easy. If a slice is bigger than when it should be, it's telling us sell high and trim it back. If a slice is smaller, it's saying buy low and beef it up. Now, of course, It might be that you say, okay, clean energy is really low, and I think that with the current administration that it won't do well going forward. So maybe you're going to replace that with Tech B or RD or Bitcoin fund or the Ethereum fund. All right, let's keep moving. So what about gold? You can actually watch the interview I had with gold veteran Rob McEwen from a couple months ago at youtube.com/Natalie Pace. You can email us if you want the direct link. Now he's got McEwen mining, that's gold and silver, but they also have a big copper interest in Argentina. And Argentina is one of the countries that is actually expected to grow pretty well, at about 5% GDP in 2025. It actually had a recession last year. One caution, though, is that these perceived safe havens are actually quite volatile. So having, whether it's crypto or gold or silver, having a hot slice of it and rebalancing it at least once a year ensures that you are capturing gains at the high and adding more if it goes down in value, rather than just riding these wild, wild swings that happen between crypto bulls and crypto winters, or gold bulls and gold bears. So again, if you're 50 and you're overweighting 20% safe, what that means is that if the markets drop, let's say you only have 30% at risk, they drop half, you've lost 15%, and hopefully you're earning at least 5% on the safe side. That can almost make up for that, keeping you very buoyant and the liquidity that you need to buy low or to buy something else that you think might be in favor. Now, the really important thing here is that most people don't buy low because they can't. They lose too much in recessions. We're going to talk about that strategy in just a moment. But this is what I was saying, is that you might consider de-risking your portfolio by overweighting a little bit safe because of all of the things that I have just characterized. So again, you can personalize your own pie chart. Just email us. BRICS are something, they're still a very small portion of the world currency, but clearly they would like it to be larger, and they are in alliance with that. And both China and Russia, a lot of these countries, in fact, are increasing their gold holdings to make their currency more attractive. I wanted to say that we are looking into other countries and diversifying, especially in our value funds, because you can often get a higher credit rating and a higher yield if you are willing to go outside our country. Not always the higher credit rating, but often the higher yield. So we are looking at other countries, especially for our value funds, because when stocks are at an all-time high, what's on sale? That again is something we talk about for a full day at our financial freedom retreat. So I was reminding you, like, for instance, what about a country that is very strong in copper? And we do have one of those, and it's also giving you about a 4% yield. So should you just buy and hold or wait and see? And what about those paper losses? Well, the nest egg pie chart strategy earns gains in recessions and outperforms the bull markets in between. So just being age appropriate, properly diversified, and knowing what's safe in a debt world and rebalancing it once a year. That's what it is. That's what the knitting that you really want to stick to. And remember that it's really fun to gamble with your money when you win, and it's no fun at all if you lose. So, right now with stocks at an all-time high, you might be feeling euphoric, but that's when the maximum risk is. And remind yourself how you felt at the bottom of March 2020, or at the bottom of March 9th of 2009. And that should sober you up a little bit. I'm happy to send you also the asset bubble chart. So again, we have a higher debt, much higher than it was before the Great Recession, 100 trillion in total debt and loans in the US. That's pretty eye-popping, and it's double what it was before the Great Recession. Again, stocks are very expensive. In fact, the only time when stocks were more expensive based on the CAPE ratio was in the dot-com recession. And that's at a time when dot-com stocks and the NASDAQ lost 78%. So $1 million went down to 220,000. That is no fun, especially if it takes 15 years to crawl back to even, which is what the NASDAQ took in the wake of the Great Recession. This is the Warren Buffett indicator. And by that one, stocks are more expensive than they have ever been. So this is another thing I wanted to just remind you of is that, if you wait for the headlines, it's late. We overweighted safe on our pie charts in December of 2007. The recession announcement came just a few months before the bottom, and you'd already lost about 40% of your wealth at that time. And this is what I already told you about the NASDAQ. The S&P lost 38% in 1 month in the pandemic. Now, of course, it came back very quickly. And of course, the recession announcement was after that. But we don't print up $4 trillion just to avoid a recession. They were really, really worried about the pandemic. And that's why we printed up all that money. And that's why we're in such debt now. And of course, we even had a credit downgrade. So we're not AAA rated by Fitch. We still are by Moody's. So again, when you wait for the headlines, it's too late. It's only fun to gamble when we win. So now is the time when we really do want to be age appropriate, properly diversified, and rebalancing and leaning into what's hot, right? Make sure that you are not in a conservative portfolio that is invested in long-term government bonds, or that you're missing large cap growth. And even try to consider having an extra slice of breakthrough technology or of artificial intelligence. And if you did already have that, capture some of those gains. It's not all, it's not nothing. And this is just a reminder. This is one of my testimonials. This couple, they just used this pie chart system. And as you can see, they made money instead of losing. A lot of the people around here lost more than half of their wealth. And it took about 6 years to crawl back to even. Of course, if you had Lehman Brothers, it could have taken a lot longer. So again, this is our next retreat. And if you do register by January 31st, you're going to get the best price and a free coaching session. So call us or email info@nataliepace.com now. Remember, you can also get a link to personalize your own sample pie chart, or you can ask for links to some of our blogs. And thank you again for joining me. I do also have video conferences at least once a month at youtube.com/Natalie Pace. So be sure to subscribe there, and also on my Instagram channel at instagram.com Natalie Wynne Pace, WYNNE. Thank you so much for joining me, and I look forward to seeing you in April.